Hi, I'm Mike Swanson. The topic of today's video blog is Finance Company Loans for Contingent-Fee Law Firms.
Welcome to the YouTube channel of Michael J. Swanson. Michael is the author of How David Beats Goliath and is the CEO of Advocate Capital. And now, here's Michael.
You may have heard me say before that banks have a hard time understanding contingent fee law practices. When a bank looks at a potential lender and looks for collateral, when they look at a law firm like that, they typically don't see much in the way of physical assets. And the accounts receivable, if you will, of the law firm doesn't look like accounts receivable they're used to. They're used to seeing someone who has created a product or service and then created an invoice for that and sent it to their customer. That's accounts receivable to them. But a contingent fee law firm doesn't have that. They have contracts between them and their clients, which enables them to get paid a fee if they win the case, and then they have receipts from expenses they've had during the case. So banks have typically not served this market very well, and because of that, over the past few decades there have been several private companies that have sprung up attempting to fill that gap in the marketplace. Well, because they are private companies, they don't get access to the kind of funding that banks do, so their cost structure is much higher. Typically they're financed by private equity funds or hedge funds, and they may have a little bit of senior bank debt in there, but it's typically overall cost structure much higher than banks. Therefore, they have to charge a lot higher rates than banks. We're seeing rates in the marketplace right now from non-bank finance companies somewhere between 18 and 25% for a working capital loan. So you can see it's a very expensive form of capital, so you need to have a very clear plan as to why you would want to borrow money at that high of an interest rate. You need to have a very clear plan as to how you're going to pay that back. Otherwise, you might get stuck having a 20% interest rate loan for a long period of time. Probably not a good idea. Well, there are some benefits in working with some of these non-bank finance companies because they specialize in this industry. They're able to understand a contingent fee law practice model a lot better than a bank. In fact, what they'll often do is send someone into the firm to look at their case inventory, and they'll actually put a value on that inventory and count that as net worth at the law firm, where a bank would never be able to do that. So because of that, they're able to extend credit typically easier than banks. Also, non-bank finance companies are not regulated as banks are by state and federal regulators, so they have a lot more flexibility in terms of the deal structure and the timeline and things like that. An interesting side note about this product as we're seeing it being marketed today, it's that sales reps with these expensive loans are saying to law firms, well, yes, I have a loan with a 20% interest rate, but that's a good thing because it's tax deductible. Well, of course, business interest is tax deductible, but that doesn't make it a good thing. A tax deduction is nothing but an expense, and you should seek to have as few expenses as possible, not as many as possible. So if the best thing you can say about your product is that it's tax deductible, you don't have a very strong product. Well, that's all for today. Stay tuned.
Thanks for watching. Send your questions or comments to Michael at mike@howdavidbeatsgoliath.com.